Most people think the Federal Reserve was born out of wisdom. A group of brilliant economists and bankers sitting in a room, calmly designing the perfect system to protect America from financial chaos forever. That is the story taught in textbooks. Calm, official, inevitable. But here is what nobody tells you. The Federal Reserve was not born in a marble building in Washington. It was born in secrecy, on a private island, under fake names, with the men who created it terrified of being discovered. And the reason they were so afraid is the same reason most people still do not understand what the Federal Reserve actually is, who actually controls it, and why it exists at all. Today we are going to walk through the real story, not the sanitized version. The one involving a financial panic engineered by the very man who later positioned himself as America's savior, a secret meeting on a remote island off the coast of Georgia, and a small group of the most powerful bankers in the world who quietly wrote the blueprint for the institution that would control the entire American money supply. By the end of this, you will understand why some economists still call it one of the most consequential and least understood decisions in American history. Let us start with a question that sounds simple but almost nobody can answer correctly. Before 1913, who controlled the money supply of the United States? The answer is nobody. Not officially, at least. There was no central bank, no single institution setting interest rates, no lender of last resort, no entity managing the currency supply for the entire nation. This was actually intentional. The founding generation of America had deep suspicion of centralized financial power. Thomas Jefferson famously distrusted banks, believing they concentrated dangerous power in the hands of a few. Andrew Jackson, decades later, went to war politically against the Second Bank of the United States, eventually killing it because he believed it served the interests of wealthy elites at the expense of ordinary farmers and workers. So, for most of the 1800s and into the early 1900s, the American banking system operated without any central coordinating authority. Thousands of individual banks issued their own currency, backed by their own reserves, following their own rules. It was chaotic. It was also, in many ways, exactly what a certain segment of American society wanted: freedom from centralized control. But that freedom came with a brutal cost. Without a central authority to step in during moments of crisis, the American financial system was extraordinarily fragile. Panics happened constantly. There was a major financial panic in 1857, another in 1873, another in 1884, another in 1893. Roughly once a decade, sometimes more often, the entire banking system would seize up. Banks would fail by the hundreds. Ordinary depositors would lose their life savings overnight, and the economy would spiral into depression. Each time, the country survived, barely, and each time, almost nothing changed. There was no institution capable of stepping in and providing emergency liquidity to stop a localized panic from spreading into a nationwide catastrophe. Then came 1907. This is the year that changes everything, and it is the year that almost nobody outside of financial history actually understands correctly. The Panic of 1907 began with something that sounds almost comically small by today's standards. Two speculators attempted to corner the market on a copper mining company called United Copper. The scheme failed spectacularly, but the men behind the failed scheme were connected to a web of banks and trust companies across New York. When their scheme collapsed, rumors spread that the banks associated with them were insolvent. And in a financial system with no safety net, rumors were enough to trigger real disaster. Depositors rushed to pull their money out of the Knickerbocker Trust Company, one of the largest trust companies in New York. Within hours, the Knickerbocker collapsed. Panic spread to other trust companies and banks. The New York Stock Exchange nearly shut down entirely as prices collapsed. And here's where the story takes a turn that most people never hear about. There was no Federal Reserve to step in. There was no central authority with the power to inject emergency liquidity into the system. So a private citizen did it instead. His name was John Pierpont Morgan. Morgan was, by 1907, arguably the single most powerful financier in the entire world. He personally summoned the heads of New York's major banks and trust companies to his private library on Madison Avenue. He locked them in a room. He reviewed their books personally, deciding which institutions were worth saving and which were not. He personally coordinated the injection of tens of millions of dollars to prop up the banks he deemed salvageable. He effectively acted as a one-man central bank, using his personal fortune and his personal authority to stop the panic from destroying the American economy. And it worked. The Panic of 1907 was contained largely because one extraordinarily wealthy private citizen decided to intervene. Now, here is the part that should genuinely unsettle you. The very fact that the country's financial stability depended entirely on the goodwill and the personal fortune of one man terrified the American political establishment. What happens next time? What happens if Morgan is unavailable, uninterested, or simply not alive? The nation had just witnessed in real time how fragile its entire economy actually was. And this fear became the justification, the emotional and political fuel, for creating a permanent institution that could do what Morgan had done, but without relying on the whims of a single billionaire. That institution would eventually become the Federal Reserve. But here is where the official story and the real story begin to diverge sharply. In the aftermath of the panic, Congress created something called the National Monetary Commission, tasked with studying the banking systems of other countries and proposing reforms for America. The commission was led by a senator named Nelson Aldrich, and Aldrich was not a neutral outside observer. He was deeply connected to Wall Street. His daughter was married to John D. Rockefeller Jr. He was, in essence, family to one of the most powerful banking dynasties in American history. In November of 1910, Aldrich organized a trip that history now refers to, quite accurately, as one of the most secretive meetings in American financial history. A small group of men boarded a private train car in New Jersey under the cover of night. They were instructed to use only first names or, in some cases, fake names entirely, to avoid being identified by reporters or by anyone who might recognize them together. The group included Nelson Aldrich himself, Assistant Secretary of the Treasury Abraham Piatt Andrew, and several of the most powerful bankers in the world at that time. Henry Davison, a senior partner at J.P. Morgan & Company. Frank Vanderlip, president of the National City Bank, which represented the Rockefeller banking interests. Charles Norton, president of the First National Bank of New York. And Paul Warburg, a partner at Kuhn Loeb & Company, and one of the most sophisticated banking minds in the world, having studied European central banking systems extensively. They traveled to a remote and exclusive private retreat off the coast of Georgia called Jekyll Island, accessible only by boat, owned by a small club of some of the wealthiest men in America. And there, over the course of about 9 days, hidden away from the press, from Congress, and from the general public, this small group of bankers and one senator drafted the foundational blueprint for what would eventually become the Federal Reserve System. Frank Vanderlip himself later wrote about the secrecy of the trip in his memoirs, admitting decades afterward that if it had become known at the time that a group of bankers had gathered in secret to draft banking legislation, the bill would have had no chance whatsoever of passing Congress. His words, not a modern conspiracy theorist's interpretation. He described feeling as furtive as any conspirator, and stated plainly that they were determined to keep the whole thing secret. He even went as far as to say that he had never been more secretive or more stealthy in his life than he was in the days leading up to that meeting. Now, does this mean the Federal Reserve was some kind of shadowy plot by evil bankers to seize control of America? That is where the popular conspiracy version of this story goes too far and loses the actual historical nuance. What actually happened is more complicated and in some ways more interesting than a simple villain narrative. The men on Jekyll Island were not trying to create some kind of secret shadow government. They were trying to solve a genuine, serious problem, the extreme fragility of the American banking system. And they were doing so from the only perspective they actually had, which was the perspective of the banking industry itself. But their solution was inevitably shaped by their own interests. They designed a system that would centralize monetary control in a way that reduced the kind of catastrophic panics that had plagued the 19th century. But they also designed a system that gave the banking industry itself enormous influence over how that centralized authority would actually function. The plan they drafted at Jekyll Island became known as the Aldrich Plan. It proposed a National Reserve Association, essentially an early version of a central bank that would be controlled largely by the banking industry itself, with relatively limited government oversight. When the plan was introduced to Congress, it faced immediate and fierce political resistance. The public, and much of Congress, was deeply suspicious of anything connected to Aldrich, given his obvious ties to Wall Street and the Rockefeller family. Many Americans, particularly from the agricultural South and West, viewed the entire proposal as a scheme by Eastern banking interests to formalize their control over the nation's money supply. The Aldrich Plan in its original form died in Congress, but the underlying problem it was meant to solve did not go away. The country still had no mechanism to prevent another panic like 1907, and so over the following years the plan was reworked, renegotiated, and repackaged, this time with significant input from Democrats and from politicians who were suspicious of Wall Street, most notably Virginia Congressman Carter Glass and Senator Robert Owen from Oklahoma, along with President Woodrow Wilson, who had campaigned in part on the promise of curbing the power of Wall Street monopolies. The revised plan attempted to strike a compromise, creating a system with 12 regional reserve banks spread across the country rather than concentrated entirely in New York, with a Federal Reserve Board in Washington appointed by the president to provide public oversight over the system. This was meant to balance the technical expertise of the banking industry against the political accountability of an elected government. On December 23, 1913, just 2 days before Christmas, when much of Congress had already left Washington for the holidays, President Woodrow Wilson signed the Federal Reserve Act into law. The timing itself has fueled endless speculation over the decades, with some arguing the bill was deliberately passed while opposition was distracted or absent. Historians disagree on how intentional this timing actually was, but there is no dispute about the outcome. The Federal Reserve System was born. Here is where I want you to pause and really sit with the significance of what had just happened. For the first time in the history of the United States, a single institution now had the power to control the nation's money supply, to act as a lender of last resort during financial panics, and to influence interest rates across the entire economy. This was an enormous concentration of economic power, arguably one of the most significant institutional shifts in American history. And it happened not through some dramatic public referendum or extensive national debate, but through a legislative process that began with a secret meeting on a private island that the American public did not even learn about until years later. Now, this is the point where I need to correct one of the most common misunderstandings about the Federal Reserve, one that gets repeated constantly online and in certain corners of alternative history content. The claim that the Federal Reserve is a private, for-profit corporation owned by a handful of secret banking families, operating entirely outside government control for private gain. This claim is not accurate, and repeating it without nuance actually undermines the much more interesting and factually grounded story of how the Fed actually works and where its power actually comes from. Here is the more precise reality. The Federal Reserve is a hybrid institution, a strange blend of public and private characteristics that does not fit neatly into either category. The Federal Reserve Board of Governors, based in Washington, is indeed a government agency. Its members are appointed by the President and confirmed by the Senate. Its decisions are subject to congressional oversight. It is required to report regularly to Congress, and its chair testifies publicly before lawmakers multiple times a year. This part of the system is genuinely public and genuinely accountable in a formal sense. However, the 12 regional Federal Reserve banks, the ones spread across cities like New York, Boston, Chicago, and San Francisco, are technically structured as private corporations. Each regional bank is owned by the commercial banks within its district, who are required by law to hold stock in their regional Federal Reserve Bank as a condition of membership in the system. This is the detail that fuels most of the conspiracy narratives, and it is technically true. Private commercial banks do hold shares in their regional reserve banks, but here is the crucial nuance that gets lost. This stock ownership is nothing like ownership of a normal company. Member banks cannot sell their shares, cannot trade them, and receive only a fixed, legally capped dividend, historically around 6%, regardless of how profitable the Federal Reserve System actually is. They have no meaningful control over monetary policy decisions. They do not get to vote on interest rates. They do not control the money supply. The real power over monetary policy sits with the Federal Open Market Committee, which includes the publicly appointed Board of Governors along with regional bank presidents, and which operates under a legal mandate set by Congress, not by private banking interests seeking profit. Perhaps the most important fact that undercuts the private profit narrative entirely is this. The Federal Reserve is legally required to return the vast majority of its net earnings to the United States Treasury every single year. This is not some obscure loophole. It is standard practice. In most years, the Fed transfers tens of billions of dollars in profit directly to the federal government, money that effectively reduces the national deficit. If the Federal Reserve truly existed primarily to enrich a small group of private banking families, this legal requirement to hand almost all of its profits over to the government would make absolutely no sense. So why does the myth persist so powerfully? Partly because The origin story, the secrecy of Jekyll Island, the involvement of figures like Rockefeller and Warburg, genuinely was shrouded in real documented secrecy, which makes the more extreme claims feel plausible by association, partly because the Federal Reserve System really is confusing and unusual in its structure, blending public accountability with private sector components in a way that most government institutions simply do not, and partly because the Fed genuinely does wield enormous, largely invisible power over the daily economic lives of every single American, whether through interest rates that determine the cost of a mortgage, or through decisions that can trigger recessions or fuel booms, and people are naturally suspicious of concentrated power they cannot see or directly vote on. But understanding the real history matters more than believing the exaggerated version, because the real history reveals something arguably more important than a simple secret banking conspiracy. It reveals how thoroughly private financial interests were embedded into the design of a supposedly public institution from the very beginning, not through some hidden plot, but openly, structurally, by design, because the men writing the rules were the same men the rules were meant to regulate. That is a much more uncomfortable and much more historically grounded truth than a cartoonish secret society narrative. Now let us talk about what happened once the Federal Reserve actually started operating, because its early track record complicates the story even further. The Fed was created specifically to prevent devastating financial panics, and yet within less than 2 decades of its founding, the United States experienced the worst economic collapse in its history, the Great Depression. Milton Friedman and Anna Schwartz, in their landmark study of American monetary history, argued convincingly that the Federal Reserve did not merely fail to prevent the Great Depression, it actively made the disaster significantly worse through a series of catastrophic policy failures, allowing the money supply to collapse by roughly a third while thousands of banks failed, and the Fed sat largely paralyzed. The very institution created to prevent exactly this kind of catastrophe presided over the worst one in American history, just 16 years after its founding. This should force us to ask a deeper question. Was the Federal Reserve fundamentally flawed in its design from the very beginning, precisely because it was designed largely by the banking industry it was meant to oversee, rather than by independent economists with no personal stake in the outcome? It is a question historians still debate intensely, and there is no single satisfying answer. What is clear is that the institution has evolved dramatically since 1913, gaining far more explicit power over monetary policy through subsequent legislation, particularly after the Great Depression, and again after the financial crisis of 2008, becoming steadily more central to the functioning of the entire global economy, not just the American one. Here is something that genuinely deserves more attention than it typically receives. The story of the Federal Reserve is fundamentally a story about who gets to write the rules of an economic system, and whose interests those rules ultimately serve. The men who gathered in secrecy on Jekyll Island were not evil in any simple, cartoonish sense. They were, from their own perspective, solving a real and urgent problem. They had personally witnessed the chaos of 1907. They understood, probably better than almost anyone else alive at that time, exactly how fragile the banking system truly was. But they also could not help designing a solution that reflected their own worldview, their own incentives, and their own position within the existing financial hierarchy. This is not a uniquely American problem, and it is not unique to banking. It is a pattern that repeats throughout history. Wherever the people with the technical expertise to solve a problem are also the people who stand to benefit most from how that problem gets solved. And this pattern is exactly why the true origin story of the Federal Reserve matters so much today, more than a century after that secret meeting on Jekyll Island. Because the Federal Reserve is not some distant historical curiosity confined to textbooks. It remains right now one of the single most powerful economic institutions on the entire planet, capable of influencing global markets with a single sentence from its chair, capable of determining whether millions of people can afford a mortgage or a car loan, capable of either preventing or triggering economic recessions that ripple through the lives of ordinary families who will never once set foot inside its marble buildings in Washington. Understanding where an institution like this actually came from, the real, documented, sometimes uncomfortable history, rather than either the sanitized textbook version or the wildly exaggerated conspiracy version, matters enormously. Because both of those extremes, the version that says the Fed was created through pure, disinterested wisdom, and the version that says it was created by a secret cabal purely for private enrichment, actually obscure the much more useful and much more historically accurate lesson buried underneath. Powerful institutions are rarely created by purely neutral parties acting with no self-interest whatsoever. They are almost always shaped, at least in part, by the very people who stand to gain the most from how those institutions ultimately function. The real history of the Federal Reserve does not require exaggeration or conspiracy to be genuinely alarming and genuinely important. The documented facts alone. A private financier personally bailing out the American economy in 1907. A secret meeting under false names on a private island. A legislative bill shaped substantially by the very banking interests it was meant to regulate. And an institution that subsequently presided over the worst economic collapse in American history less than 2 decades after its creation. These facts alone tell a story compelling enough and cautionary enough without any embellishment required. So the next time someone tells you the Federal Reserve was simply the product of careful, neutral economic planning by disinterested experts acting purely in the public interest, you will know that story leaves out the train car crossing into the New Jersey night, the false names, the private island, and the very real fear, admitted openly by one of the participants himself, of what would happen if the American public ever discovered exactly how their central bank had actually been designed. History is rarely as clean as the textbook version, and more often than not, the real story is the one nobody wanted written down in the first place.